Hello, in this video we are going to understand the concept of EFR. It stands for External Funding Requirement or Additional Funds Needed. So this is a question that through which we are going to understand the concept. This is a very good question. We will get the full picture of the concept. Okay, so the idea is of the concept of EFR is to understand the question that there is a there is an increase in sales and we want to support that increase in sales by basically investing in assets. And to invest in assets, fund those assets, we need funds, right? So we are going to answer how much funds we will need to invest in those assets to support the corresponding, let's say, increase in sales. And that uh, funding can be through equity or through debt, by issuing equity, raising through debt, and some part can be also financed through internal funding, that is return earnings. So we will have all the information. We will use that information to basically answer the question. Let's go to the question. There is a company which, which for which income statement and balance sheet are given to us, and also additional information which is critical and requirement part. We have sales, we have cost and expense, we have income before tax. Currently, the sales are sitting at 7,500. Okay, and the net income at 140. We have equity of 2,000, fixed assets of 4,000, debt of 2,500 currently. Okay, so additional information company expects a 40% sales growth next financial year. Okay, company will have 25% dividend payout ratio next year. And important is that all costs, okay, cost, current assets, and current liabilities are expected to increase in sales. Okay, so that is like 40% also, 40%. And except return earnings, no equity is to be raised. So basically, we are not financing through equity. That's important. So everything is here. Finance will be financed through debt. And I have also given a requirement part that complete EFR through raising long-term debt. But the critical information is under which is if the company is operating at 65% capacity usage for fixed assets. Okay. So this is important. So basically what does this mean is like if you have to explain, so let's say we have a hotel and there are 10 rooms, okay, total 10 rooms, each having 1,000 rent per day, 1,000 uh, rent per day. These are rooms, and let's assume out of the 10 rooms, 8 are on rent and 2 are vacant. So this means 8 upon 10, 8 by 10, which is 80% is the fixed asset utilization currently. And they are not utilized at 100%. So we are able to generate a revenue of 1,000 into 8, currently of 8,000, right? But the full capacity sales will be what? If we were to use all the rooms, then we will be able to generate sales worth 10,000. That is, increase by, if we calculate 10,000 minus 8,000 upon 8,000, that will be 25,000. So if we were to use all the assets or at 100% capacity, then sales will be 10,000, which is an increase by 25% without increasing the assets, without basically investing in new assets. With the current asset only, we are able to basically reduce the sales by 25%. So that is the idea of the capacity thing. So let's proceed with the question and try to understand it. Okay. Okay. So basically, this is the information given at the current time. What we will do is we will approach this question is first we will uh, try to uh, draw performer income statement, which is nothing but a forecasted income statement with the given information. So the information says company expects a 40% sales growth next financial year. So in the next financial year, our sales will be 7,500, right? 7,500 into what? 1.4. So 7,500 into 1.4, that gives us 10,500. So 7,500 into 1.4 less cost. Costs are also going to increase by 40%, right? All costs, current assets, current liabilities are expected to increase with sales. Okay. So currently cost is 7,300 into 1.4, it is 10,220. So if we subtract the both, what we will get? 280 probably. Tax is 30%. So let's consider that 84, and then we will get finally 196 as the net income. And dividend payout ratio is also given to us. So which is nothing but out of the income, total net income, how much we are going to pay out to the let's say shareholders. And the balance will be what return earnings or internal financing, as you can say. Okay. So dividend is 25%, which is 49, and balance, which is 147, is our return earnings. Okay, so that's our performer income statement. Now the next important thing we will do is, of course, draw performer balance sheet. Okay, now our equity is 2000. Okay, important thing which comes here is now the return on which is 147. Right, this is the money surplus which we have not distributed to the shareholder and which is with us. So this can be used to fund the assets. But we will see still if we require. If we require extra money, okay. Now let's this current liability, which is currently at 1,500, but it is also going to increase to 40%. So 1,500 plus 40%, that will be 2,100. And then next net fixed assets is at 4,000. I just skipped line for a moment. I'll come to it later. Current assets 2,000 plus 40%. Doesn't matter. So remember what we are going to do is okay, sorry, long term debt. I also keep it blank. Okay. We'll basically try to find it as a balancing figure. Okay. Now important thing is, so net fixed assets are at 4,000. Now we are operating at 65% capacity, right? So what we will try to figure out what is the full capacity for it. So if we were to use 100% of the assets, then what will have been the sales? Currently, our sales is 7,500. Okay, currently, so simple formula which we can write, which is full capacity cells into percent capacity currently utilized is equal to current cells, right? This is X. Currently, 65% is the capacity that we are using. And current cells is 7,500. So if you try to figure out X, that will be 7,500 divided by 65%, which is 11,538.46. So at 100% utilization, our cells could be 11,538.46. Now, the next year, which we are forecasting the sales growth of 40%, which is 10,500. So now what they will do is basically simple, add investment of 4,000 in fixed assets at 100% capacity. We will be able to generate sales of 11,548.45. So 4,000, so basically what I'll write is fixed asset upon sales. This is at investment worth of 4,000. We are able to generate sales of 11,538.46, right? Now we will try to figure out fixed asset at sales of 10,500. So 10,500 is our forecasted sales. Okay. At that level, what asset we need to support that? Okay. And if you try to let's say calculate it, so this basically will be cross multiplication of 10,500 into 4,000 divided by 11,538.46. Okay, so first of all, okay, so 10,500 into 4,000 upfront 11,538.46, which is 3640. So we need assets at 3640. So basically, to support the sale of 10,500 with a 40% sales growth of next year, the requirement in the assets net fixed asset is 3640 now. So let's try to figure out long-term debt. It's a balancing figure. So basically, let's total this both sides. We can see 3640 plus 2,800, which is 6440, and this will be 2,000 plus 147 plus 2,100, 4247. This is 4247. Subtract 6440. You get 2193. 2193 as long-term debt. Now, currently, debt is sitting at 2,500. 2193. The current our debt is 2,500. So to support this sales growth bar of 40%, we need debt of 2,193. As actually, you can see we don't need additional debt, but our debt is negative. 2,500 minus 2,193 is minus 307 approximately. Actually, we don't need any additional debt to uh, basically support the increase in such because our current capacity of 4,000 worth of investment of fixed assets for 4,000 crores is sufficient to basically support the increase in sales growth of 40%. Okay, so that's how we work through the problem of EFR. But the second part of the question is where we will see that we actually need we will actually need more funding to basically support the growth. Because in that case, our current capacity is already at 95%. At already 95% capacity, our sales is 7,500, right? And our increase is 10,500, which is as you will see, it is way more higher. And we then need external debt, external funds or debt to basically perform. So that will be coming in the second part of this video. If you like, you can try it as well. So the first approach is very best handy. Okay, thank you. Uh, See you in the second.